Howdy, Jacob here. Today we're looking at Darden Restaurants in the hotels, restaurant, leisure industry. They operate under Olive Garden, Longhorn, Cheddar's, Yard House, Capitol Grill, Season 52, a couple other restaurants, incorporated in 1995. So they own some restaurants that I think are pretty solid. I mean, Olive Garden, you look at Italians, they probably don't like it, but I think the average American does. Longhorn's got a fantastic medium cooked ribeye. Cheddar's has a surprisingly great chocolate cake. Yard House has some massive deals and a massive 3 foot beer. Revenue growth 6.8 billion to 11.4 billion. Pretty impressive. Only dropping during COVID. Outside of that, huge, massive growth afterward. Gross margins are not very impressive, but operating margins are still in the double digits recently. So it looks like their cost of goods sold is really all their expenses. Their dividend is paying out a good amount of their earnings per share. So we'll see what that capital allocation is on a relative basis, but it likely is high. Return on invested capital, also very good. So likely putting down stores, they're able to get a good return, maybe after 4 to 6 years, get the money back. That's not a bad investment. Balance sheet shows 195 million cash on hand with 87 million short-term debt and 1.4 billion long-term debt with a hefty amount of capital leases. So huge amount of their expenses are just, or huge amount of their liabilities are capital leases, which makes sense. They own and operate a bunch of stores, or they lease and operate a bunch of stores, I should say. Their cash flow statement, huge production, free cash flow recently, and it's because their cash from operations over tripled with CapEx not even tripling. And so they've been making a lot more money. Their form of capital allocation is acquisitions, share repurchases, and then a dividend that pays out a 3.5% yield. That is a massive dividend, and it's also a massive payout. You're looking at over 60% of payout going to dividends, maybe 30% to share repurchases, and then 10% to acquisitions. So let's start making some assumptions here. I think and a little bit to reinvestment. Interesting. So we see that the form of capital allocation has grown greater than 100% because they have net issuance of debt rather than payment to the last 5 years. But anyways, their revenue growth, I think placing down stores and new locations with all the places that they have, I think they're able to grow 5% a year. I do think that there is some competition, but I think I'm still comfortable with margins of maybe 8 and 9%. Share change, 1% is about 190 million. Top stock-based compensation, 250. I think I'm good with that as well. So that's 1%. Terminal PE, I mean, there is competition, but I think some of these are pretty household names. So maybe let's go 17. Maybe I'm being generous. I don't know. Dividend is already paying out a huge dividend. I'm not going to increase that even with this revenue growth because I want it to dampen down to 50% max paid in a dividend. If you have other forms of growth, I prefer just not handing the check to the shareholder. I think there's better allocation of capital personally. But even with these assumptions, not looking terrible. I mean, drop 37% to get to the return we look for today. I think that they own a bunch of pretty well-known chains, and I think that the numbers look pretty decent to me, but not quite decent enough to buy immediately, but still pretty decent. So hope you enjoy the video and have a great rest of your day.